In this class we're going to discuss accountancy and the role of accountancy in the business, and we're going to pay particular attention to costs. A good accounting function is essential for any business. The purpose of accountancy is to allow businesses to keep track of their resources, of their money. That's an essential function. If the business doesn't know where its money is, or where it's coming from, or where it's allocated effectively, the business will not be efficient. In fact, the business may not survive. So the purpose of accounting is to keep the business on track and to ensure that it knows where its resources are and how effective its investments are. Accounting is all about recording, preparing and interpreting business transactions. This information is made available to people who need it, such as managers or owners, and who then can use the information to make decisions to improve the performance of the business. Without information, effective decision making is impossible. It's guesswork. So it's the function of the accountants to ensure that information is flowing, accurate information is flowing and analysed, so that effective decision making can be made, areas of concern can be addressed, and perhaps profitable areas can be expanded. Management accounting is used to monitor, plan and control the activities of a business. So it suggests there are other types of accountancy. We have identified one here called management accounting. Management accounting is internal to the business. This allows the business to understand how much profit they have made. Do they have enough cash to pay the employees' wages? It's essential that the information flows accurately to ensure that management can make decisions and that the decisions can be resourced. If it can't pay employees' wages, can't pay salaries, the business will cease to exist. Also, shareholders have invested in the business to set it up in anticipation of receiving a return in the future. This return is in the form of dividends. If the business can't pay dividends, then the shareholders are not getting anything back, so they have no interest in the business. In fact, the business could be taken over by a competitor because the business is, in effect, it is not making a profit and it is not worth anything. When it makes a profit and it pays all its expenditures, wages, salaries, raw materials, pays for energy and the telephone, and pays for everything, there should be something left over to pay for the shareholders and give them a dividend, and that's what maintains the value of the business. If they can't do that, the business could be taken over by someone else or could be closed down. Also, the accountants, in working out the profits and in looking at the business critically all across the business to ensure that there are no inefficient practices, to ensure that it runs smoothly, they may be setting aside resources for business expansion. For example, if there were areas that could be further developed, and markets that could be further developed, then business expansion may be a good idea, but it takes resources to do so. And those resources have to be planned within the accounts. They don't just appear, they have to be generated out of profits, perhaps, and then spent in this way through investment to expand the business. So that discussion that's just gone suggests that there is management accounting. There's also financial accounting. And if we start with the accountancy function in the business, we can break it into two parts. First of all, financial accounting. Well, financial accounting will deal with the cash flow statement. Now, this is dealt with in a separate video, but for the moment, this is an absolutely crucial document in the management of the business. It is vital that the management know that it can pay its bills when they arise on a day-to-day basis. So this statement shows bills as they're falling due in the future and shows what income's coming in and attempts to marry the two up to ensure that at any one moment in time the business has the resources to pay its bills and to have perhaps something in reserve. So the cash flow statement is absolutely essential. Financial accountants also prepare the balance sheet. At the end of the year, the management want to know, as a snapshot, where have they got to? What is the current state of the business? How profitable is it? What are its costs? What are its revenues? It needs a statement, and that is the balance sheet. Now, if it's a public company, the balance sheet will be made public, so anyone can see it. This means the competitors can see it. Everyone can see how the business is doing. So it's vital that the balance sheet is prepared accurately, and this is why the accountancy bodies have standards, and accountants who are qualified must behave reputably in developing the balance sheet. The financial people also prepare profit and loss accounts and income statements. In fact, these are prepared before the balance sheet, generally speaking, so it prepares a set of accounts to show if the company is generating a profit or incurring a loss. It can subdivide these ones into a trading account, which looks at sales and the cost of sales. Then it looks at the detailed expenditures in the profit and loss, which shows whether the business is making a profit or not. And finally, it compiles the balance sheet and perhaps publishes it so that the outside world can see it. So the financial performance is really aimed at the outside users, the shareholders, the lenders, the suppliers, the customers, and even the government, because this will be used as a basis for taxation, to pay corporation tax. The second type of accounting is management accounting. Now, in there we have cost accounting, in other words, controlling costs, and this is a very complicated area of accountancy. The management accountants do not produce financial statements that are published to the world. These are internal to the business. These are used to control the business. And one vital area is the control of costs. Many items, many departments in a business run right across the whole business. Now, if the business makes 5 or 6 different products, what proportion of the overhead of that department should be allocated to that particular product, to that line of production? Well, management accountants have various techniques that they deploy in order to try and allocate or apportion costs to particular products. Again, for effective decision making, that is a crucial area. And it's the general information that they collect and analyze and present to management that enables management to make the decisions. So management accountancy is aimed at internal use. It helps them to make good decisions. Now let's look at cost accountancy for a little while. Management accounting or costing is the basis for pricing and stock valuation. It's used as a basis for pricing. if you know what the costs are, then you can't sell under that. If the raw materials, labour and capital and so on costs £100 to make this product, and if you sell it for £90, every item you sell you're losing £10. So the more you sell, the more you lose. But you have to know what the cost is in the first place, and that's the province of the management accounting function. And the management accountants will try to work this out. So costing as a basis for pricing and stock valuation, it's used for planning and the control and performance of the business. So it all feeds back into budgets and how the budgets are prepared, and this is the baseline. If they don't know what their costs are, and they don't know what the cost of making the product is, then they can't set the price effectively, which means presumably the business would just imagine a price. They might be lucky, they might not. Chances are they won't in the long run, and they will go out of business. Decision making, short-term decision making, these include break-even and contribution analysis. And break-even is the subject matter of a separate video, but the company must know what volume of output is necessary in order to break even on the accounts. Anything above that perhaps will generate profit. Long-term decision making is the province of management and strategic management in particular, looking at capital budgeting and investments and long-term finance, expansion, entering new markets, developing new products and that sort of thing. But again, it must be paid for, and it's the cost accountants who ensure the costs of the existing business are managed and controlled in such a way as to generate profits. So, in terms of cost, this is the amount of resources, usually measured in money terms, that are sacrificed to achieve a particular objective. That's what a cost is. It's the amount of monetary resource that's given up to achieve a particular objective. These objectives can be for anything: to buy a car for the business, or to buy a house for whatever purpose in the business, make a particular product or perform a particular service. It doesn't matter. The objective is to ensure that the cost is at a minimum, that the best deal is driven for the business, and it meets a particular objective, perhaps a strategic objective, a long-run objective that will bear fruit in the future. The aim of the business is to make a product or service and to attract a customer attention. Customers could be from the general public or from another business, but the idea of a business is to produce a product or service that is attractive to other customers or to customers. If it makes a product or service that nobody wants, you can imagine what's going to happen to the business in that case. The more people that buy the product or the service, the more profit it will make. Well, presuming if it's got its pricing right, if it knows what its costs are, if the cost accountants have provided accurate information of the cost of the product or the service, so that a markup is added to generate the profit, providing it's selling above the break-even point. There are lots of little provisos in the statement, but generally speaking, in common parlance and common language, the more people buy the product, the more profit the business will make. So it's important for any business to control its costs and increase profit. If it doesn't have profit, it won't be in business. If it doesn't make enough profit, it won't be able to reinvest. It won't be able to pay depreciation on its machinery, perhaps. It'll go obsolete. It won't renew the product. It doesn't have research and development. It won't innovate. The long-term prospects for such a business are not good. So it's important that it controls its costs and generates profits. Now the classification of costs. Well, the main classifications include material costs. This is one way of looking at it, I should say. These are the cost of obtaining the materials and receiving them within the organisation. Even the cost of shipping the materials, which is called carriage cost, the cost of carriage. All of these must be taken into account. So the business must have materials to run. It must have paid the labour costs. These are the costs in the form of wages and salaries, and general employment costs. It may have to have a doctor or nurses resident on the premises. It may have to have health and safety expenditure items to ensure the safety of its workforce. It may have to have special clothing, or there are many issues involved in having workers, not just the question of paying them wages. So there must be some sort of grouping of costs under that heading. And the last one, which I just flashed on the screen earlier, is the expense costs, or the overheads. These are external costs such as rent, business rates. The government imposes a tax on the business to raise revenue for its own purposes. Electricity, gas, postage, telephones, and so on. And these must be grouped together and paid as well. Some of them are fixed. There's an element in electricity bill, for example, that is fixed charge. And then there's an element which is variable. The more you use it, the more you have to pay. So those are three classifications of costs from this particular perspective. So in this class we've looked at the two types of accountancy, management and financial, and we've emphasized the importance of costs and the management of controlling costs, and said it falls mostly to the management accountants, to the cost accountants as they used to be called, who need to ensure that inefficient parts of the businesses are identified and corrective action is taken, profitable parts are looked after and perhaps expanded, and generally speaking they bring their costs under various headings such as the ones we've got on the screen at the moment. So that concludes this talk on costs. Thank you for watching.